I'm your host, Michael Thayer, and in studio today we have Brad Smith with Keller Williams and Andrea Brewer, the birthday girl from Benchmark Realty. Woo-hoo. And touching on interest rates, the Fed meeting is this week, and we don't expect anything to happen with the short-term rates, but a lot of people get things confused, and so does the media, about when the Fed meets and they talk about raising or lowering interest rates. Listen to what they're saying. They're always saying short-term. A mortgage isn't short-term. Mortgage is long-term. So when they reduce the short-term rates to help fight inflation or whatever they're trying to do, it's affecting loans for credit cards, auto loans, some student loans, depending on how they are. But it's those shorter-term type of loans, not your mortgages. So there might be a window of opportunity where we could see rates dip a little bit when the Fed actually increases the short-term lending rates. But there's another rule that was changed, that has changed, that was in the same release, talking about unreimbursed employee business expenses, which we've discussed this many times on our show when we're talking about the pre-qualification process. And what we do at Waterstone is a much more thorough pre-qualification, where we're actually going through your tax returns, double checking to make sure there's nothing there that an underwriter would find that could possibly trip you up. Same thing with your pay stubs. We're asking for 2 to 3 recent pay stubs. In some cases, we may ask for a full month's, but what we're looking for is any kind of abnormal deductions or anything else that shows up in your pay stubs that shows inconsistency. And then the same thing with your tax returns. We're looking for any kind of unreimbursed business expenses, any kind of Schedule C income. So if you're self-employed or you have 1099 income that taxes weren't withheld from, we're looking for that kind of stuff, because you may think you're making 50, 60, 100 grand a year, but the way you're filing your tax returns, it may be half of that. Now what they're saying, and basically this is a rollback back to the way it was, if I'm not mistaken, lenders are now only required to document and reduce qualifying income for unreimbursed employee business expenses for borrowers earning commission income that is 25% or more of their employment income. So basically, if you earn commission or you're on a bonus and 25% of that income is the bonus or commission income, then we still have to look at your unreimbursed business expenses. So it goes on to state, no documentation or deduction from the monthly income is required for borrowers being qualified using base income, base pay, bonus, overtime, or commission income that is less than 25% of the borrower's annual income. So, to me, this is going to open up a huge area for where we've unfortunately to tell people, hey, we understand it's a paper loss, or not even a paper loss, it's a paper deduction to lower your tax liability, but we can't qualify you. And a lot of people don't realize, until you get in the situation and you unfortunately run into that denial where underwriting saying, well, the federal lending guidelines say we have to calculate your income this way. The IRS guidelines say we have to calculate it a different way. And they're different. But yet you're making 100 grand a year, and one says you can count 50 grand, and the other one says you can't even count anything remotely close to that.
When the economy went down and the market was slow, I went back to waiting tables. And of course, I was still doing my real estate, but it was just slower. And I try to sell every chick in their house.
Right.
And the tip thing was always a big, your income's set up differently. It is harder to get qualified for a loan, and it was stated income, and how everything's done is totally different. So you have to be, you have to put that money in the bank. But it is set up now where most people pay with credit cards, and you just about have to claim your tips. You really do, because so much of it's electronic anyway,
right,
that it evens out.
But the whole purpose of talking about this tip income is because of the rule change, and now we can count that tip income. And I know these rules are boring and there's nothing sexy about them, but I don't know how else to convey it other than to read some of it. But basically, as long as the client reports the additional tip income over and above their W-2, or what their W-2 is reporting as their tip income, then you can actually use that additional income that you've been reporting for the last 2 years as income. The point of this show today has been just, there's a lot of rules that are finally relaxing and finally being rolled back from the stringent,
Right.
black and white, no gray area kind of thing. So, Andrew, you mentioned about the stated loans. I mean, those aren't coming back, but I mean, they're at least trending that way. So I know some people have this perception in the market that financing is tough. I can't get financed. You can't get approved. Nobody's lending money. That's crazy. The money's there.
Yeah.
You have to fit inside that box.